Yeah, hi guys, welcome to the next episode of FINtastic Talks. So let me thank again by all the love and affection that you have shown. We have a number which I'm very pleased to share that last both episodes have crossed over 1 lakh views. So more than 1.2 lakhs to be exact. People have watched that video, and that's a great thanks to all of you for taking out time and watching this, and so that we are able to contribute to your journey. The whole purpose of this fantastic show is to help people build a second income. Now people ask me, what does this second income means? Second income means that you need to be able to build your investments as a second income. Most of us are busy in our work, but we never look at creating wealth. Now people ask me, what's the difference between being rich and wealth? So rich means that if a person has 1 crore rupees, he's rich. But if he's spending 10 lakh rupees every month, he's going to finish that money in 10 months. He's not going to remain rich. Whereas wealth is having enough money which can give you the lifestyle you want for the rest of your life. And that happens by building a second income. And building a second income starts by making investments and treating your investments like a business. That doesn't mean that you spend all your time into that, but you look at it very professionally every once in 15 days, 30 days, and try to be dispassionate about it. That look, I have to build a corpus that is going to support me one day. In mutual fund industry, we have this very simple quote called 15 15 15. That means if you invest 15,000 rupees for 15 years and are lucky enough to be able to generate a 15% return, you'll have 1 crore rupees. So, and you can play around with this. And if you look at the rule of 72, which is 72 divided by the return, the money doubles that period. So if you look at it, this 1 crore will become 2 crores in 20 years, 2 will become 4 crores in 25 years, and this 4 will become 8 crores in 30 years, provided you're able to get that return of 15%. And guys, that happens by being very dispassionate and not looking at your portfolio on a micro basis, but investing in good mutual funds, investing in good debt schemes, which are able to give you the average return that you are looking for and meet your risk profile. So that's the whole purpose of this show, and I hope we are taking you on the right track. Today is a very interesting time because when every episode, either the market is on a high or the market has gone down. So one episode we are talking about the crash or the market being depressed. Other episode we are talking about the bounce back and the comeback. And also we have today with us Avinash, and that's also very very interesting person where a lot of you have had these questions about. Franklin Templeton Mutual Fund, and it's one of the most popular funds in the country. And now Avinash has taken on the mantle of bringing it back to its rightful position. So a lot of people have the questions regarding Avinash, and I think it'll be a very interesting talk today. So Avinash, great to have you with us today.
Thank you very much, Sanjiv. Happy to be here.
Yeah. Thank you for taking out time. And probably you are the most anticipated CEO. I'm on this show because I'm sure a lot of people indirectly ask these questions about Franklin Templeton and the plans and other things. So to hear it from the horse's mouth is going to be very interesting. And Franklin has always carried this huge love and affection in India. So when they say when people are oversensitive, when they love something too much. So it's going to be a very interesting. But before we jump onto it, let us understand a little bit more about you. Why don't you tell us a little bit about your childhood, your schooling, and how did you get into this industry?
Sure. So I've actually born and brought up in Mumbai. Studied in Mumbai, did boarding school for a period of time in Pune. Did my undergrad in Mumbai, and then started working in Mumbai. I actually started out in the on Dalal Street in my summer after my 10th standard. So as an intern or essentially as a summer job, and spent a enjoyed myself in that summer and essentially continued since then. So I made my first equity investment back when I was, I think, 15 or 16, and haven't stopped since. So after that, joined Franklin in the US, was a fund manager there, was an equity analyst also, then have kind of worked and lived around Asia as well. So I ran our joint venture in Vietnam for 5 years, and then right before coming back to India, I was running our business in Malaysia.
That's great. And a little bit about your family. So was money in your blood, or this is something you acquired later?
For to a certain extent, I would say, I mean, finance has always been in my in the family, but to a limited extent. It's been more doctors and artists, if you can kind of believe that. But I started, like I said, once I got a sense of making that first round of investments, that essentially had me hooked. And I continued making those investments right throughout and haven't stopped. So almost 30 years
We
later.
have a lot of youngsters also watching this. So, and you made a journey to Wharton. And so, how did that happen? And today, especially we are living in a world where a lot of youngsters are going abroad and doing a graduation, but they're not
Right.
actually doing a master's. At least in India, I see that whole craze for masters has gone down. So, just tell us that why did you choose Wharton? That's the let me say
Sure.
it's the Harvard of finance education. For those who don't know the Wharton's, quality, and it's one of the most difficult institutions to get into and one of the most amazing institutions on finance. So Avinash, how did you make that journey?
So I think quite simply, it's kind of what you said, right? I mean, it is, if you want to do finance and you want to focus on a higher education, Wharton's as good. I mean, there's a number of different schools, but Wharton definitely specializes in finance right alongside University of Chicago. And so for me, it was more about when you're trying to decide whether you're going to do an MBA, biggest questions you always ask is, what is the reason you're doing this, right? A lot of people are doing it because they're trying to change their careers. So you've gone into, let's say you're an engineer or you're kind of a liberal arts major or whatever it is, and then you're trying to make a switch. A lot of times that MBA helps you to kind of take that break, gives you a broader set of skills that help you manage a business. And then you can make that switch across to whatever new career you're planning to. So there's different, right? Different schools have different strengths, right? I mean, if you think about Northwestern, strengths in marketing, you think about Harvard, it's general management. You think about Stanford, it's entrepreneurship. If you think about Wharton, it's finance. So for me, I didn't really want to do anything else other than what I was doing. So I'm kind of boring and one track in that sense. So it was more about getting a little more of a skill set, getting more of an understanding and appreciation of the broader business management. And that was kind of why I kind of explored going and doing an MBA.
That's superb. And any tips for the students who are watching it, how to get into Wharton?
Okay. I don't have any tips per se, but what I will say is,
Yeah, हम stock
don't
market के
don't
लोग हैं ना, so everything is a tip.
yeah, that is true. I would say that, don't necessarily worry about just your GMAT scores or anything like that. It's a lot of it is about your experience and why it is that you want to do it, right? And those are the two main things that I think the schools are looking for. They want to understand what is it that you want to do, and at the end of the day, every school wants to see their students do well, and they want to essentially they're placing a bet on you that you are going to do well, and therefore, then when you're sitting on a show like this, you'll have Sanjiv asking you, "Oh, you're a Wharton grad." Right? I mean, that's essentially what Wharton wants. So what you have to show to them is, what is your story? What do you want to do with it? And how you can show that you're going to be more successful at it. So I know a lot of time people spend studying for the GMAT test and making sure they ace it and score really well. Yes, that is one element of it, but your experience, what you want to do, why you are actually pursuing an MBA are far more important. So I would say spend a lot of time on understanding your story and history and why you're doing it.
So, Avinash, let's come to our topic for the day. The markets have been highly volatile. We have this volatility, and there is a lot happening globally. There's an inflation pressure coming up, yet, the Indian markets are still defying all odds. And then, the correction that people were very scared of has actually turned around. And we had hit, again, we were in the high zones. And then there was a minor correction. But now we are seeing a bounce back. So, what do you feel about global economy? What is happening? Where do we stand? What is your opinion on that?
Sure. So, let's take a look at it. I mean, there's volatility, and I think the markets are going to stay volatile for a fair bit of time, I feel. Partly because there's a lot of moving parts right now in the global economy, right? I mean, we have a number of negatives that are going on in the market, right? I mean, you've got inflation that's going extremely high in the West. You have the war in Ukraine that seems to be waning, but it's not going down. There's concerns around potential recession in the US. Now, if there's a recession in the US, the rest of the globe is going to have an impact. So, in my mind, volatility is going to stay. But the way I think of kind of how we want to invest in these markets and what it means, especially on the global side, or even domestically in India, is you want to stay invested, right? I don't think timing the markets, coming in, going out, really kind of benefits you in the long run, right? So something that you brought up earlier when you were talking, right? The rule of 72, right? Or the 15, 15, 15, right? If we actually held on and just stayed invested, right? And didn't do anything, you benefit a lot more. And those rules actually then play themselves out, right? I mean, I keep saying this to our team that what we do isn't rocket science. It's actually very simple, but there's a huge amount of emotion that messes up our decision-making skills, right? So, I mean, we ran this study on the Nifty 50, and we ran this over 25 years. And if you'd invested 1 lakh and 25 years ago, you'd have 16 lakhs today, which is a 12% compounded annual return. Right? Now that's 25 years, right? If you think about it, there are 240 trading days in a year, right? So over 25 years, that's roughly about 6,000 days, 6,000 trading days. Now, if you missed just 5 of those trading days, that happen to be the best 5 trading days, right? So you are invested in the market for 5,995 days, but you missed the best 5 trading days. Your returns drop to 9.6% annually. So instead of making 16 lakhs, you are now down to 10 lakhs. So just imagine, just 5 days you've missed and your corpus is down. So if you miss 10 days, that corpus goes down to 7 lakhs. So you may have invested for 25, but if you miss the 7 best days, your compounding effect is dramatically hurt. So I think the story is volatility is going to be there, but use that as an opportunity.
Yeah. So guys, just to explain it a little bit easier. So, it's all about being like, if you're in a mutual fund, then the fund manager is taking those calls for you that you don't miss any of those days. And all you have to do is, okay, and commit to long term. You need to choose a good fund, and all you need to see every 6 months, 1 year, and preferably 1 year only, that am I invested in a fund manager who's good? Is he performing well? Can he be in the top 25 quartile? And also, a person who was a best performer earlier doesn't have to be a best performer in the future. So you have to understand, like, Bajaj Capital comes up with a research advice that why are we expecting some fund managers to outperform in the next 1 year? Because of the calls they are taking and what is the rationale or what is the base behind those calls. They don't have to go right or they don't have to go wrong, but it is the fund manager. So the point is the wealth creation is simply by staying invested. There is a very interesting topic of behavior finance where Wharton played a huge role. It talks about like, look, if you stay in the market for 10 years, 100% of the people will make money. But 92% of the people don't make money because they exit when the market falls and they get over bullish when the market goes up. The point is, like, if you start a SIP, then start a SIP. Don't look at the returns for 15 years. Just they sure that you're in the right fund. And the second is, if you're making an investment, please be very clear on your investment horizon and stick to it and stay in it till there. So that's what we are talking about. So Avinash, before there are a lot of questions. So there is some questions which are like we have some very regular viewers. So they are asking us some tough questions, and I want to take them first, and then we
Okay.
get into this. So there's one of our viewers, Madhusudan. He's asking this question. Your reputation he's asking, is your reputation of your AMC restored now after there was some issue with some challenges that you have faced, and we are sure that that you will return back with a bomb, with a bang. So we can what can we expect, what has been learned from those lessons, and how would Franklin Templeton be different now?
Sure. So let me answer that in a couple of parts, right? One is the biggest factor for us. I mean, just for those people that don't know what happened, we did in 2020, there was a liquidity concern, and we had to stop redemptions in 6 of our debt funds. And at the time, there were all kinds of stories and rumors and stuff like that Franklin was not going to be able to survive this, you would never get your money back, etc., etc. Now, fast forward 2 years, we have returned over 100% of all the money, and those funds have had a return. There are, of the 6 funds, there are 4 funds that have been completely extinguished, as in all the units have been extinguished, money has been returned, and the return has been anywhere between 7 to 15%, depending on what your return, what your fund investment was. So we do have 2 remaining funds where we are in the process of kind of winding those down. And by the time they are all done, it will be over 100% return anyway. So in that sense, I feel that in history, if you look at recent history, right, in the financial markets in India, there has not been another case where you've had monies that have been returned back to the end investor in whole, right? I mean, if you look at most other cases, it's still pending, or it hasn't happened, or it's never come back, or what have you, right? So has our reputation, I think the question was asking about, has our reputation been fully restored? I don't think it's been fully restored. And I think it would be a bit naive to think that it would be fully restored so quickly. But to a great extent, it has been restored. And the example is our recent NFO, right? I mean, we just we launched the Franklin India Balanced Advantage Fund, and we had almost over 30,000 investors. Of those 30,000 investors, the thing that I found most interesting and exciting was the fact that over half of them were existing Franklin Templeton investors. And to me, that is a huge positive sign, right? Now, what that also says is that nearly half of the investors were new to Franklin Templeton, right? So that brand or that reputation, concern, and risk, is it still there? To a little extent, I'm sure it's there. But to a great extent, I feel like it has been mitigated for the most part. And we'll keep doing it. I mean, we'll keep functioning the way we have. And over time, I feel that I don't think we'll be too far from recovery.
I think, Avinash, that's very well answered, very honest, and very upfront, and I think very reassuring for everyone that Franklin is back, and it's back with a bang. So we have a very similar question, although you have already answered. There's a
Hmm.
gentleman, Mr. Murali KS, who's also a very regular viewer. So
Hmm.
he's asked a question, but what we can pick up from there is that what are the lessons learned. So in future, just on the lessons learned, and how would you?
I can read I read the question there. One thing I will correct is there was no scam, right? So I don't like the word scam because scam suggests there was some wrongdoing on Templeton's part, Franklin Templeton's part, and that is not true. Because if there was a scam, the money would not have been able to be returned. Quite honestly, right? Now, but the other question is fair is an absolute fair question in terms of what actions have been taken and how and why do we trust Franklin Templeton again. What I will say is right after uh, there have been a lot more stringent guidelines that have been placed on kind of investment guidelines um, to kind of control the level of investment that we make. Now, what ended up happening in our case was that it was not necessarily a credit issue, as in the investments were not bad investments, right? Because if they were bad investments, we would not have been able to sell them and return the money with a return right now, right? So they were not bad investments. What happened was the timing, and there was a liquidity concern. So if you think about back in April or May of 2020, lockdown had just been put in place. So there was a lot of concern around the markets, and this is a global phenomenon. So when liquidity became a concern, it was harder for our positions to be sold, which meant it was harder to meet redemptions. So what we're looking at right now is any strategy that we look at in the credit space. The focus will be not just on looking at the credit risk, but the focus will also be looking at the liquidity risk. And that is, I would say, one of the bigger learnings for us is making sure that that liquidity risk is understood just as well. And to a great extent, Sanjeev, quite honestly, it is more about the vehicle that you use, right? If you have illiquid investments, you cannot have a vehicle that allows daily liquidity, or you shouldn't, because then there's a little bit of a mismatch, right? Because if your illiquid investments you cannot sell, then if you've got daily liquidity, that's exactly what the problem was. So I think that the lessons are in that. It's not just, it's more around making sure you match the product that you have with the vehicle that you should be selling it through.
Yeah, I think that's very well said. And we'll just take one final question on this. Isha has asked a question. Uh, so Isha Sharma, she's asking, okay, given that what happened, how should an investor create his basket or a portfolio for a good investment horizon for 10, 15 years? So Isha, I think you have asked an amazing question, and this is something that everybody should know. It is called asset allocation. Don't put all your eggs in one basket. So if a investor had all his money in debt funds, only then he would have faced that issue. So please don't do that. You must allocate your assets. So when you have an asset, you must take a bank FD. You must also look at the GOI bonds and other bonds available. Then you must look at a debt mutual fund, and then you must also look at an equity mutual fund. So you have to spread your asset across, and if you do a proper asset allocation, then even if there is some liquidity crisis in some part of your portfolio, and these are called credit funds, where the aim was to get higher interest rates, and higher the slightly higher the risk, slightly higher is the return. So that's a question. So point is, you need to allocate. One of the biggest mistakes I see investors making, they will choose one fund, two fund, and they'll put all their money. And I see some financial planners also talking that don't over diversify your investments, and just that's wrong. I'm saying don't over diversify means don't select 50 schemes, but you need to have at least 5-10 schemes. If you have a decent enough corpus, if you have a bigger corpus, maybe even 15-20 schemes. Would you like add anything to that, Avinash?
So, Sanjiv, the only thing I will add to that, quite honestly, is yes, asset allocation is absolutely critical, like you said, right? Finding the right asset allocation. But what I would also add is that you want to find a good advisor, right? You want a good advisor who can act as a guide to help you decide what those funds are, what those schemes are, what that asset allocation should look like. That is critical. And I think people tend to discount the value of advice a lot. And I found that the advice given is usually good advice is quite honestly the best investment you can actually make in your journey. So that's the only thing I would add. I completely agree with you that asset allocation is key, but you must find a good advisor to give you the right asset allocation.
Yeah, I didn't want to sell myself, so you need a Bajaj capital. So you need a Bajaj capital, and come to us, and also listen to the research and tell the wealth manager to bring the research reports. What is research talking about? We do a monthly webinar with our research head. You must listen to it, understand what's happening in the market. It'll add a lot of value to you. So now coming back to the markets, now there's also one of our very regular viewers, Ashok Kumar, who's asking this question that global inflation, US 100 bips point bond yields, have increased. So what is the concern for the Indian market due to that?
Sure. So I think inflation is not a new phenomena when you look at it in the India context, right? I mean, we have lived with 6 to 7% in annual inflation for a long time, right? It's not been one of those things where all of a sudden now we're facing 7% inflation, right? We've had it. It's either 5%, it's either 7%, but somewhere in that range we are used to that. The West, on the other hand, is not used to it. So, I mean, I can give you an example. When I lived in the US, right, price changes would never happen, right? A product that you purchase today, 2 years later, you're most likely paying the same price, if not slightly lower, right? Because they've increased in scale or whatever, right? So the concept of inflation had been done away with over for the last 40 years. So there's been no real, very low inflation, 1-2%. So now when they're facing inflation, it is a massive issue. So what ends up happening, quite honestly, is if you look at it over the last 10 years, or I would say even longer, the amount of money in the system as a consequence of quantitative easing from the central banks, there is a lot of liquidity, and that generally leads to inflation, and we've just not had it. So the two triggers to drive inflation this time around were COVID, when everything shut down. So all our production stopped everywhere. So supplies reduced. So supplies reduced, but the demand was still the same. So you naturally have that inflationary push. And then with the Ukraine war, there are actual supply chain disruptions that have occurred that has led to real shortages, right? So, I mean, I'm sure a lot of you have been trying, if you've tried to buy a car, you know what the waiting periods are now, right, to buy a car. So I know I was looking at, I think, one of the Mahindra cars, and it's something like an 18-month waiting period to get the car, right? I mean, that's because of these supply chain disruptions. So how does a central bank control inflation? The only tool a central bank has, or the main tool they have, is to change the cost of borrowing, which is your interest rates. And so interest rates have been going up, and the Federal Reserve is taking it up. And I think there's another decision coming tonight. And the expectation is that the Fed is going to raise it anywhere from 75 basis points to 100 basis points, right? And if they do that, what does that mean then? So two things, right? Inflation, is it a real problem for us in India? Not right now, right? Is it 7%? So it's beyond the official RBI range, right? It is beyond that. Will RBI follow through and raise it to the same level in an attempt to control inflation? It's possible, but maybe not necessary. The risk with mismatch on our interest rate rises compared to the US interest rate rises is the impact on the foreign currency. So that's where you've seen the rupee that has gotten a lot weaker. So there are a number of things that are in motion, right? So just because US is raising 100 basis points, the impact on the Indian markets is that you will see an upward bias to interest rates, but maybe not to the same extent.
Very well answered again, Avnish. Avinash, sorry, it was absolutely a very, very crystal clear answer. And so let's now go to the next question, which is, and there are some nice questions by Isha and others, which have already been covered in this question. So there's a lady called Tanya Sharma. She's asking a question. Okay, let's bring it to me. She's saying that what is the best Franklin mutual fund scheme you would recommend to invest in to me today and why?
Okay. So I know what I can say is that there are 4 equity funds that we've kind of focused on, right? And before I say that I would recommend to invest in, I will actually go back to what I said earlier, which is you should and must talk to an advisor before you make any of your investments, right? Not because you can't make those decisions yourself, but an advisor can help guide you and help you understand what your risk appetite is, what your horizons should be, and what other options you have, right? So you want to make sure that you do that. Now, on a Franklin basis, what I would say is one of our flagship funds is called the Franklin Flexi Cap Fund. That's been around for over 20 years, has a nice long-term track record. But then there is also our focused equity fund, our Templeton Value Fund, right? So these are some of the funds that I would say, that fit what I think is going to be a volatile market for the next 12 to 18 months and their ability to weather that storm. But I would also say that you also can look at investing in some of the larger caps, mid caps. So you need to think about it. But I would say, at least from a focus standpoint, you want to invest in or you want to look at those funds.
Yeah. So, guys, we had also answered this question in a couple of episodes back, where we had told you, given the volatility in the world and what is happening, this is a time for a general person to be more oriented towards large caps. So those are bigger companies, they are more solid, they have the capability. And if you look at this bounce back, what has happened is that a lot of people say, look, the bounce back has happened, but my portfolio has not grown. Now, that is because the bounce back has not really truly happened in a lot of the scripts. It has happened in a small number of scripts. So those people who had invested in a large cap or an active large cap have got or a focus scheme had got quite a decent return, while others may have got left out. And also the Sensex has changed because of the change of the constitution of the Sensex. So that also has an effect on this thing. But today it's slightly better to be more conservative, be more towards large cap. Either you do it yourself or you choose a flexi cap where the fund manager takes these calls for you. Also, Avinash, sorry, you have now recently launched a Balance Advantage Fund, which is the bread and butter of the mutual fund industry today, and it's a very, very popular product. So why don't you explain to our viewers about this product and what do you feel about it?
Sure. So I think a Balanced Advantage Fund as a category, the reason it has appealed and has done so well as a category is, if you think about it, what does a Balanced Advantage Fund do? It gives you the benefits of equity investing with lower volatility, right? So it gives you 65+% investments in equity. That's the exposure that you want, and the balance is in fixed income. So if you're in a market that is, you're fairly unsure of what's going on with the market, or you don't like to see the volatility, a Balanced Advantage Fund gets you that exposure, gets you that initial step in with giving you those returns without having the same level of volatility as an equity fund. So our fund in particular, I mean, there are a number of different Balanced Advantage funds in the market, right? So like you said, Sanjiv, I mean, this is a very large category and there's a lot of different players. But I would say our fund uses the same algorithm. So we have had a fund called the Dynamic PE Fund that has been around for about 19 years. And the algorithm that it uses, so that fund was more of a fund of fund concept, whereas the Balance Advantage is a direct investment. But the algorithm that is used there is exactly the same. So this is the same algorithm we've been using for the last 19 years, very successfully. And now it essentially does. So in the algorithm, the two bits are, there's a price to earnings component, and then there's a price to book component. And those are the two valuation metrics we use. And that's 50-50. And based on that, there is an allocation that the algorithm tells you of how much it should be invested in equities at any given point in time. Now, what our portfolio manager then does is has the ability to overlay their view on the macro on top of that, and then make their asset allocation decisions. So there is a little more of a nuance to this Balance Advantage fund.
Superb. And I think, guys, it's a great product where you're letting the fund manager do your allocation between debt and equity. And one of the reasons these funds have been doing very well is that, we talk about rebalancing your portfolios. There's moving from debt to equity, equity to debt. And here the manager is doing it on your behalf. So when the markets fall, the managers will most likely move more towards equity. And when the markets are very heated up, they'll probably move more towards debt, and they will do a little bit of profit booking for you. So it works quite well. Also, Mayur is asking a very contra question. So Mayur Kashyap is asking that, do you think a strategy of higher exposure to mid cap and small caps is going to work, given that they are coming at a better price now?
Sure. So if you think about market caps, right, and so there's large cap, mid cap, small cap, right? Now, just for your benefit, I used to, when I was managing money as a fund manager, I was a small cap fund manager. So I have an inherent bias that I like small caps. And the reason I like small caps is they tend to provide you much larger capital appreciation potential. Now, they are also significantly more volatile than a large cap. So there is a time and place for each one of these market caps, right? So is a strategy of higher mid caps and small caps going to work? Now, what I would add to that question, Mayur, is it going to work over the long term, right? If you add that over the long term, I would say fundamentally small caps tend to give you a much better return over the long term compared to large caps. Now, it's natural because small caps tend to be slightly higher risk as well. So if I'm going to take more risk, I should be getting a higher return. The other thing you want to think about is where we are in the business cycle. So right now, there's a concern that the US will potentially go into a recession. Going into a recession, you want to have larger cap exposure, as Sanjiv was saying earlier, because they're more stable companies, they're more well-known, they don't have to worry about capital, they don't have to worry about having to make interest payments on their debt. They're more stable, right? But as you're coming out of a recession, now in India, I think the odds of a recession are fairly low, but we are likely to have a slowdown, right? So let's equate a US recession to an Indian slowdown, right? If we go into a slowdown, then as you're coming out of a slowdown, or in the US as you're coming out of a recession, that's when you want to be a little more exposed to small caps. Because as the economy recovers, the benefits that small cap gets falls directly to their bottom. So there is a much higher likelihood of them outperforming. But that's not necessarily always true. But generally, in a business cycle, that's what you want to do.
I think, again, an amazing answer, Avinash. Now, Mr. Malhotra, he's, I think, invested in your Franklin Asian Equity Fund. And he's saying that, he's not seeing great returns in that. What's your view on that?
So the Asian, now, when you say Asian equity fund is not performing for the last couple of months, I will say, in general, I don't worry about something that's not performing for a couple of months. It's more like are invested for the long term. Having said that, if you think about Asian equities, Asia in general has had a tougher time, especially what's been going on with China in terms of their slowdown, their controls in place, etc. So has there been some exposure and some impact from that? Across the board, there has been some impact. If you take a step back and you look at it from a macro perspective, right? In my mind, Asia is one of those regions that has tremendous growth potential and has much stronger growth potential in the long run. So you want exposure to those areas, just like you want exposure to India, because India has actually got incredible growth characteristics in front of it, right? So similarly, Asia has that, because if there's any other country that you would compare India to, it's probably most likely going to be China. Now, China is large, but I think China has sustainable growth. There's a question mark if they can continue doing that. But the rest of Asia, Southeast Asia, there are definitely opportunities. So I would say that you want to stay invested for the long term and use volatility as to your benefit. Make it an opportunity where you lower your average cost.
That's a very good way of looking at it. That challenges are actually an opportunity. So
Exactly.
that's, I think, very well answered, Suraj. I hope you got your uh, answer to this question. Alicia Pachai is asking a question that how do you envision India's future? With more and more people getting financial literate, do you think that's going to be a key factor in driving the Indian markets? In addition to the other stories on Made in India and others.
No, I actually am. Maybe I'm slightly biased here, but I've been a bull on India for a long time, right? And I think India has a number of things. I'm sure you've heard of the demographic dividend. That is a real positive for us because that is unique to India. China does not have it. None of the West has it. There's not any other large economy that has that where more than 50% of its population is young, right? As that grows in there. Now, if I'm looking at the long term for India, it's not just, I think financial literacy is one part, but when I look at the younger population, as they start moving into the workforce, as they start earning income, see, the initial thing you will do as you earn income is you tend to spend a lot, right? You'll buy a new first car, you'll buy your first house, you'll buy your first whatever, right? But once you've done all your firsts, you're not going to buy 20 cars. You're going to buy maybe 1, 2, 3 cars maximum, right? Then you're going to start investing. So that's going to expand out the investment pool and the financial services that go alongside it. So financial literacy, quite honestly, is a very, very important subject. And that is something that we spend a lot of time on in terms of making sure people understand. And I'll just give you a simple statistic, right? I mean, we've got our population today, there's only 2% of the population that has invested in mutual funds. Now, when you look at that compared to, let's take the US market, nearly 50% of the population is invested in equity markets and in mutual funds, right? So we have a long way to go. And a lot of that has to do with education on financial literacy, on financial subjects, on the ability to make investments, on the options to make investments. And I mean, if you look at, let's say, for example, bank deposits right now. So total bank deposits in the system, mutual fund assets account for about 23% of bank deposits, which means 77% of bank deposits are just sitting in cash. Now, why aren't they sitting in a mutual fund earning more? It's financial literacy. It's education about your investment options. So I think as that expands, as that grows, and as an industry, as we start doing more of that, or continue doing more of that, it will lend to broadening out and deepening our capital markets even more.
And I think, and it was a very important question. And I think the next question I'm going to take up, which is a very simple question. Shreya Singh is asking, but it's an important question. Actually, a lot of investors ask me, how do I track the performance of my mutual fund scheme? Now, point is, guys, here I'll say that, come to Bajaj Capital. We'll give you a portfolio report which will show you your performance of the mutual fund scheme. It will show you the CAGR. It will show you many more details that if you are invested in 15 mutual fund schemes, what's the underlying equity holdings, where are you exposed to, where are you not exposed to. So, guys, it's through the portfolio reports that you get, and these portfolio reports are available even free of cost with BajajCapital.com. You can create your report even if you're not a Bajaj Capital investor, and there are so many other ways of so many other sites, so many who give better reports than you get from the registrar. So where you can understand your holdings into a much better manner. Next is a very interesting question that I don't know how you will answer it, Avinash. Sorry, Avinash. It's about what is your 80-20 rule for investments for retail investors. This is one of our viewers called Samaprit. Samaprit is asking. So it's interesting that like we talk about 80-20 rule. Is there an 80-20 rule for in retail investors?
It's an interesting question only because I've never heard of an 80-20 rule in investments. I mean, an 80-20 rule usually means that you get 80% of your results from 20% of your constituents. So in this case, the question would be, or the assumption would be that you're getting 80% of your returns from 20% of your investments. I don't necessarily think that's the case. So I'm not sure. I don't have an 80-20 rule when it comes to investments per se.
So, as a fund, I think your focused equity fund would be an 80-20 rule where the whole money is focused into some products where the Franklin feels that they'll be able to deliver this thing. But again, as a precaution, don't put all your eggs in one basket.
Absolutely.
Okay, and now there's another question. There are a lot of questions on this. In fact, not one, but a lot of questions where that people are asking. This is again become a trend. That not what do you have, but what are the new things that you'll be launching, and what can we look forward from the Templeton Fund House?
Sure. So there's when you look at what is our strength, right? We're a global fund house. We recently made a large acquisition 2 years ago that has given us a whole host of new products on the global front. So what would we be looking to bring into the Indian market is a combination of domestic products that make sense and global products. Right? Now, yes, global products, there are certain restrictions right now in terms of making investments in global investments, but those I don't think are going to be for the long term. Right? Those restrictions will come off. So what I would say is stay tuned. I'm not. There's no pre-release, as they say, that we're going to do right now, but we are looking to launch a series of new products.
That's this thing. So, Avinash, now one question I need to ask you is that. People are talking about a long-term story, and you said, look, long-term small caps and mid caps have the potential. Now, a lot of people will have this thing in their mind. Okay, look, if I'm looking at long-term, and you're saying that small caps, mid caps are today better priced, then if I'm coming into this market for maybe a 10-year horizon, should I look at a small cap, mid cap? So, what is your view? Is the correction that was supposed to happen in small cap, mid cap, has it happened? Or do you still feel there is some correction left? And is it, would you say this is a good time to get into small cap, mid cap for the long term?
So the way I would look at it, Sanjiv, is either, right? Whether you're looking at small cap, mid cap, whether you're looking at large caps, the question, so you asked a two-part question, right? One is the correction done, and is this now the right time if I've got a 10-year horizon, right? So is the correction done? I'm not sure, because if you look at what has been happening to the Indian markets compared to what's happening in the US, there's been a lot of talk of decoupling, right? That the Indian markets have continued to go up while the US markets have come down. Now, I don't know how much longer you can really stay decoupled, right? Because at the end of the day, we are plugged into the global economy. So in my mind, I don't necessarily think that the correction, is it done? I don't know if it's nearly done, because it hasn't really happened to a great extent, right? If we're moving the opposite direction of what the US is doing, then there isn't been a correction, right? It's been actually, we've been going up. So the way I would think about it is, you want to set yourself a goal. You want to set yourself a target. So let's say if I decide that I think that for the next 3 to 6 months, there's going to be more volatility, right? If I believe that over the next 3 to 6 months, there is going to be volatility, but at the end of 6 months, I want to have invested 100 rupees, right? I would then split it up and do it in a systematic manner, where you come in, whether it's on a monthly basis, whether it's on a weekly basis, whether it's on a quarterly basis, however you want to do it. Quarterly might be too little because you only have 2 trading opportunities, but maybe a weekly or a monthly, where you keep putting in slowly into the market. So if it is correcting, then you're averaging down. If it is necessarily going up, then you're not necessarily buying higher, and you're buying less units at a higher price, right? So you're not blowing yourself out completely. So I would say it's not so much trying to time the market. I think timing the market is the biggest problem. Saying that if this correction is not done, I'm going to wait for the correction to be done. Go back to I think the first question that you had asked me when we talked about missing out the 5 days, right? Those best 5 days typically occur right at the bottom, right? Right when you finished off the bottom, and that bounce back that occurs is generally when you have the best 5 days. So if you are not invested, if you're waiting to see if the correction is done, you will miss those 5 days, right? So I would say you want to plan it out, invest in it on a regular basis. Now, to your question about small caps versus mid caps versus large caps, right? I would say you have to have a blend of it. You should not have, to borrow your word, Sanjiv, do not want to put all your eggs in one basket or in 2 baskets, let's put it that way, right? You want to spread it out. But like I was saying earlier, if we are coming out of a slowdown, smaller caps generally have a longer trajectory and the higher level of capital appreciation opportunity. Hopefully that kind of gives you some set
I
of
think it's very
rules to
well
work.
answered, and you have actually answered my next question also. That was how should we invest in a volatile market? So, guys, just a simple takeaway in this volatile market: if you have a long-term view, go for anything; it doesn't matter. But if you have a short or maybe a smaller, short or a medium-term view, maybe large caps make sense, especially if you're looking only at 2 3 years. If you're and flexi cap funds are a great opportunity for you for this. Avinash, it won't be fair for us not to take a question on debt funds, because that's again one of the bread and butter. So the people are asking, with this RBI interest rate hikes, how is it going to impact the debt funds? And what's your view on that?
So actually, I mean, when you think about, we talked a little bit about inflation and what the US is going to do, right, in terms of rate hikes and stuff like that. I think RBI recently hiked its repo rate up to, what was it, 5.4%, and our expectation is by the end of FY23, we will settle around somewhere around 6 to 6.25%. So just shy of another 100 basis points, right? Now, is that going to be the absolute peak, or is that going to be, we think that should be, but given the conviction with which the Federal Reserve has essentially come out and said that they are going to continue raising rates. They're talking about 75 to 100 basis points this meeting. They're looking at again another 75 to 100 basis points in the next meeting. I mean, so you are looking at a fairly aggressive Fed. In my mind, like, what does that mean for debt schemes, you want to stay at the shorter end, right? You want to stay at the low maturity end for the time being. But as rates keep rising up, you then do want to start going out into longer maturities, which in effect have higher yields and higher returns and higher interest coupons. But for the time being, I would say we are at the low to mid range when it comes to debt schemes in terms of maturity levels.
Okay. So what would be one takeaway you will tell to investors that look when they're looking at debt, what type of scheme should they pick up?
So it really, quite honestly, Sanjiv, it depends on their time frame, right? If you're looking at, actually, even it doesn't
Maybe a
matter on their
1 year
time frame.
time frame, one to 2 years.
So if you're looking at making a 1 to 2 year time frame, I think you want to start having a balance between shorter term, low maturity, and then starting to take on some maturity as well. So let's say if you're looking at a corporate or a PSU type fund, or if you're currently in a, let's say, a liquid or a savings fund, right? You're starting to take some maturity and some duration. So you want to get little more into it right now. But if you ask me, best is to wait for another 3 to 6 months, because interest rates are still on an upward trajectory and they haven't stalled out as yet. So while they're still moving up, I think it's best to stay at the lower end of the maturity.
And Avinash, next question is on arbitrage funds, so which are related. So they are asking, what is your view on arbitrage funds? What kind of returns have they been delivering? They used to deliver a good, decent return, then the returns became bad. So, where do they stand and what's the reason for this?
So I mean, we don't have an arbitrage fund. So I don't necessarily, I mean, we have looked at it in the past. We don't have one. Um, and I know the next question that might come is, are we planning to launch one? We're not sure as yet, right? So we're doing some analysis. So I'm not, what I've noticed in arbitrage funds is the reason they may not have done as well is because there's been a significant amount of volatility in both asset classes, right? So that may have been one of those factors, but I don't have a very good answer for you, Sanjiv, in terms of why I think arbitrage funds haven't done well and are they likely to do well in the future. There is, I mean, theoretically, when you think arbitrage, the definition of arbitrage is a riskless profit. That's what an arbitrage is, right? So now the fact that that hasn't happened, then I'm not so sure it's fair to call them arbitrage, right? Because it is not a riskless profit.
Also on debt funds, a lot of people talk about target maturity funds. So do you have that in your portfolio, and what's the fund? Can you explain it a little bit further for our viewers?
So target maturity, we don't necessarily have anything new that we've done recently. But what target maturities are is effectively you're looking at saying, okay, I am looking at only holding this for 3 years, right? My target is that 3 years out. So what are we in 22 plus 3, 2025 are the maturities I'm looking for. And I'm willing to hold it, right? So that's my target. So all papers that I own are in that maturity range. Now, this is where I was talking about taking duration, right? Is this the right time to be taking that 3 year duration or that 3 year maturity? And some would argue yes, some would argue maybe you want to wait. We're still analyzing that. In my mind, given that interest rates are still on their way up, you still want to be a little cautious. You want to be a little careful about extending yourself out into those higher maturities. But the time is getting closer, right? It's a matter of 3 months, 6 months at most, where interest rates probably will peak out.
So, but do you have any of them in your stock that stable that you're selling at the moment?
Not at the moment, Sanjeev. Not at the moment.
Okay, and one I know we are over time, so one final question: that what can we expect from you in the next 1 year as Franklin Templeton AMC?
As Franklin Templeton AMC, okay. So there's a couple of things you can expect, right? And you've already started seeing that to a great extent. Is we are essentially getting out there, re-engaging with our investors, we're re-engaging with our partners, and you'll see more of that. You'll also see we're making investments in our brand. You'll start seeing more of that because we've been fairly quiet for the last few years. And then lastly, on the product side, you will see us launching new and interesting products, right? I mean, we just launched our BAF, which is not a new product necessarily for the market, but it is a product in a segment that I believe is continuing to grow. And we want to make sure that we have a presence and an option for our investors. And then on the other side, on the new side, you'll start seeing us bring in products that don't currently exist in India. On the global side, products that don't currently exist in India in certain asset classes. So that's what we're trying to do, is to try and bring unique things that do not currently have an offering in it.
Wow, that's very interesting, and we are very excited about that. So, thank you guys for joining us today, and thank you, Avinash. I'm sorry for calling you Avnish because
No worries.
it's over and over again. So, so thank you for being with us today, viewers. I hope we were able to help you with your wealth creation journey. It's actually a very exciting time to be investing. This volatilities are actually some of the best times to invest. So I would say if you don't have a SIP, please start your SIP. And as Avinash had very clearly explained, systematic transfer plan where you put your money into a liquid fund and then you transfer it into the market can be a great way to even do a lump sum investment rather than trying to write a check every month or 15 days. And here you can choose, you have a lot of flexibility, and today is mostly online. So it's very, very convenient, very, very easy. So we are living in a very exciting times, guys. So please do start your investment journey. And some final words, Avinash, and thank you for being with us today.
Sure, Sanjeev. I think the only thing I would reiterate is, quite honestly, there's no time, like there's no good time or a bad time to start investing. Every day is a good day to start investing. And like you said, start that investing journey and start basically putting an investment every month, putting some investments aside, whether you're doing it on an SIP, whether you're doing it on an STP, it is the right model to do it. And more importantly, stay invested. Do not let your emotions get in the way of getting you those right returns that are deserved, right? Because those are the biggest things that affect us, is our emotions when we get scared in the market or we get greedy in the market, both of which are not good for us. So thank you very much for having me, Sanjeev. I thoroughly enjoyed it. Excellent questions, and look forward to doing this again at some point.
Yeah, and I'll just finally finish with one statement which I tell my team, that if you don't run in a race, then you have already lost before you even started. So at
Absolutely.
least try, to stop waiting on the sidelines. Start investing today. Even if it's whatever amount you can afford to invest, be in the markets. For your children, the best thing to train them, as Avinash made a very important point, is that when he started investing in the market, the whole world lit up for him. He could see lights in the whole world. So make your children see the lights. Give them some amount of money. They're investing only. Today we give children money to spend. We never give our children money to invest. I don't understand the logic. So please give your children money to invest, and there are exciting times ahead. Yes, challenges will always be there, but whenever there are challenges, there are opportunities. So thank you guys for joining us today, and thank you, Avinash, for an amazing, amazing talk.
Thank you very much, Sanjeev.